Hello, my name is Glenn Bradford. This article is about Fannie Mae and Freddie Mac and why I think we're basically fueling up the rocket. Um, I've written lots of books on it. I wrote Adequately Capitalized. I wrote Net Worth Sweep. I wrote Fannygate. I wrote 3,542,600. Uh, I wrote Net Worth Sweep, same book. Capital Buffer. I mean, you get the point. I wrote books on Fannie and Freddie. The basic premise is that uh, for years the government has stolen all of their money. Late last year, the government stopped stealing all of their money. Uh, Currently, the issue with the company is their capital structure. The plan, as I understand it, is that the restructuring really is scheduled for after the election because it's a political thing. This month, Fannie Mae and Freddie Mac are scheduled to hire financial advisors with underwriting experience, and that's important because that means that these financial advisors are going to be taking on the risk of the capital raises. I mean, the companies are basically looking to uh, break all of the charts and all of the expectations in terms of the amount of money that usually gets raised in IPOs. And I would say that a fair time estimate for when the capital raise will happen would be July of next year. So basically, a year from today. Currently, Fannie and Freddie preferreds trade at about 30 to 35 cents on the dollar. I expect that in a year they'll be at 80 cents on the dollar. I expect that in 6 months, November, December timeframe, when the government does the Fourth Amendment net worth sweep, that the companies will trade between like, I don't know, 60 to 70 cents on the dollar, or the preferreds anyway. The common stock's around $2. I think that the common stock does well from here. I expect the warrants get exercised as part of the equity restructuring. I expect the senior preferred liquidation preference to get written down and also the companies to be credited with overages. This is all part of moving forward and preparing the companies to raise and hold more capital than they ever have in history. And so basically what's happened is over the last 15 years, the regulator has changed from the OFHEO to the FHFA, which is going from like a weak hand regulator to a strong hand regulator. And then the amount of money that Fannie and Freddie make has been increased significantly. I think at this point it's doubled, and that's their guarantee fees. So they're making more money than they ever have, and so now the regulator Mark Calabria basically came out and said, "Hey, historically you guys have been forced to hold enough capital based on your actual business risk." And he's like, "Well, uh, that's not enough anymore. We're going to force you guys to hold so much capital that the business economics of this business aren't important. What's important here is the economics of the agency mortgage-backed securities that you guys issue, and that is a matter of national security. And as such, as opposed to forcing you to hold enough money so that you can weather a normal downturn based on your expectations, we're just going to force you to hold as much capital as you can possibly hold." And there's a limit to that, and the limit is what capital markets are willing to raise. And I think that the capital rule that he proposed and they've come out with, uh, I think that with the financial advisors that Fannie and Freddie are hiring this next month, and then the negotiations between them and institutional investors and hedge funds and all the big money managers out there. Because I mean, to raise 50 billion plus for these companies, you really need the financial advisors to be out in the markets dealing with market participants, figuring out, where is this money coming from? It doesn't come out of thin air. And I think that these discussions that are going to start happening when they hire the financial advisors this next month, across the next 5 or 6 months, are going to really educate investors about the stock opportunities today in the public market for these preferred and common securities. So, I mean, the discount that you've been given because of whatever's happened recently, I just think is going to slowly fade until you get the Fourth Amendment, which is the rocket launch, which is the restructuring of equity, which is the thing that everyone who's been an investor in these equities has been waiting for really since, I guess, 2012, when they entered into the net worth sweep. Lawsuits were filed against it because what that is, even the current director of FHFA, which is the regulator, he says that the previous regulator basically broke the law when they did that, and he's in there to fix it. And so, it just seems like now is one of the best times. I expect that Fannie Mae and Freddie Mac get uplisted to the New York Stock Exchange before the end of the year. If you look, there was a filing filed this last week where I believe it was Fannie Mae deregistered some securities that haven't traded since, I believe, 2011 because they were preferred securities and they were equity, and they were converted to common at the behest of the company. That was part of the terms of that preferred issuance. It just goes to show how FHFA has really run Fannie Mae and Freddie Mac like a popsicle stand, really, since they were placed into conservatorship. Like, to not file, like, they're filing the deregistration for securities that haven't traded since 2011 in 2020. Like, it's clear that, they never really intended to figure out what they're actually doing. And the Trump administration had to bring in Mark Calabria, who wrote the law. He helped write the law with Richard Shelby, and so they brought him in, and now he's following the law, and his thing is capital, capital, capital. They have to have more capital than they could ever have needed in the past based on the business economics, and it's all political. It's all just forcing them to hold as much as they can. It's far more than they need. It probably negatively impacts, some of the business a little bit, but from what they're seeing, I guess it's not much. And at the end of the day, you've got, trillions of dollars of asset managers out there that are going to be working with Fannie and Freddie's financial advisors starting in the next month, really, to figure out, also with negotiations with FHFA's financial advisor and FHFA's new recently hired law firm specifically working on helping them get Fannie and Freddie out of conservatorship. So there's a lot going on. I'm pretty excited about it. I think it's probably going to be one of the best trades of the next year, as far as, I mean, the scope here is there's a lot of money to be made at every step of the way, and it may be slow in relation to, a lot of the other things that happen out there, like if you've been trying to day trade and swing trade for, like buying Hertz when they filed bankruptcy and trying to make 100% in the day on something that, is technically worthless. If you can do that kind of stuff, great. But if you want to, collect, basically, at this point, if you buy the less liquid preferreds, you're looking at 200% return minimum in the next 12 months. And, that's not bad. And so, that's really the thesis here. Hope you have a great week, and I plan on doing these on a somewhat regular basis, and so I'll see you next time.